Okay, this is a market review for the AM session, and we'll also talk a bit about the pre-market range. So we have this mitigation block from this low, this high, and this higher low. Now, this mitigation block was effective because it's very easy to tell that in this sell move and this sell move, anyone who's not taken their stop loss or full stop loss and they're holding their positions are going to be in drawdown throughout all this move higher. And because it's not showing a willingness to completely trade back into all-time highs, it's the London session, that's not going to happen. I think leaving the London session between this and the pre-market hours, 7 o'clock, we can expect it to start to draw towards that mitigation block. Why? Because this is going to act as a temporary draw on liquidity. Yes, you can use it as a support and resistance level, like you would do any other order block or breaker block, but it can temporarily act as a draw because anyone who's in sells, if their positions are to be mitigated at either break even or slightly less drawdown, then after they weather this entire move higher, it wants to trade back down into it and let them out of their positions. That's seller's remorse. Now on our first run lower, we had this high, a higher high, a higher high, and then the final one, a little cherry on top. So that's like a 4 drives. These lows here, these were low resistance liquidity. Why? Because they're relatively close. Trades down below that. Doesn't quite make it into the mitigation block. That is where I hit my trailing stop loss. And then another drive higher. Trades back down into the mitigation block. Then we put in our pre-market low. Put in our pre-market high. And here's the good stuff. AM session begins, or AM Killzone begins rather. And we sweep out the pre-market low with a 929 candle. Now I said this in the Silver Bullet mentorship ad nauseum in literally nearly every single episode. If you sweep out the pre-market low or high and it's 929 or 930 or 931 and you swept it, you have a very good chance of going into the opposite end of the range. Now combine that with the idea that we should be trading towards all-time highs eventually now, because our bias is bullish. I've been saying that in Discord this morning. We want to eventually trade into the original consolidation at all-time highs, but that means that on the lower time frames we're still bullish. So if we're bullish and we get a move against our bias, that's discount pricing now. This is a Judas swing. It's also a time-based Judas swing because 930 will either be the move that completes a Judas swing, or that goes against the Judas swing, or it is itself going to be the Judas swing. So in this case, from 856 or 855 all the way down to the pre-market low at 930, this entire move lower is a Judas swing. It's also an opportunity to get discount pricing to buy it up. And because we stay within the mitigation block from the London range, that is an area of support. When you combine the ideas that from the pre-market low, if it sweeps that at 929, 930 or 931, and it should trade back into the opposite end of the range. When you combine that with, okay, we're bullish, we've just had a Judas swing against our bias, we're being supported by this mitigation block, everything there points to buying it up into these relatively highs. If you wanted to hold beyond that, maybe you were looking for something more ambitious because you are on side if you took a buy here. The reason being in potentially holding some runners is because if we're to trade towards all-time highs and you're in buys, then that rhymes, then you're more likely to be able to hold a successful runner. So beyond this high, you can hold a couple of contracts. Say you're in 5 contracts, you can hold 1 or 2 and capture this little bit of extra move. 1.5 standard deviations and 2 standard deviations. Why am I measuring this? Well, this is the retracement against our underlying bias. So it's time-based as well. From 855 all the way into 930. Well, that, like we said earlier, is going to be the Judas swing for the open. That's very expected because you combine that with the idea, okay, we swept the pre-market low at 929. So it's likely to go into the other side of the range. And if it was likely to do that, this would be a Judas swing, which would mean it's against the underlying bias or the underlying direction. Which means it's a retracement that we can measure using fulcrums, like we cover in the final Silver Bullet workshop lecture. And I don't recommend targeting the second standard deviation if you have a large retracement. If you have something small, like this, go ahead and target the second one. But if it's a larger fulcrum, then you want to use something smaller, like 1.5 standard deviations. In a larger fulcrum, you can measure 2 and 3 and 4, but in something so large, and your take profit's here, you really don't want to be going for something crazy ambitious like a second one. You would want to take it off at 1.5. So that's very easy. Take profit. Unfortunately, I wasn't at the charts. Sounds like an excuse, but I actually wasn't. That is why I was late to the New York AM chat today. But you see how all those pieces of narrative combine with, like this gem here. When you sweep out the pre-market low and you're in an area of support and it's 929, 930 or 931, plus you get a change in state of delivery. Where's the change in state of delivery here? Well, trading above this high, closing above that high, trading above this high, closing above that high. Why this one? Well, it's separated by volume imbalance, so you could use this as a change in state of delivery. You don't need to wait for it to all the way go back up into there. You could, and it's fine. You'll still get an entry there, but for the highest precision, you would probably use this volume imbalance, or you would use the fair value gap. Why this fair value gap? Well, it's the first fair value gap before stop run. That makes it a bit more significant. It becomes an inversion gap. That can be treated as a change in state of delivery. An inversion gap is a form of change in state of delivery. Once you trade above that, and you have a reason to be bullish, like every single thing we've said, where the underlying bias was bullish, we swept out the pre-market low at the correct time, we trade back above this high now, that's a change in state of delivery, we've got support and displacement higher. This would, if narrative and time are aligned, which they are, going into the 930 open, that should act as a Judas swing, meaning we should trade above that high. All of this is narrative building. It's not 369 vortex numbers like Lucy says, the flipping fraud. It's clean, time-based, narrative building setups. And if you're wondering, wouldn't we wait for the macro? As mentioned in the Silver Bullet mentorship, you don't need to wait for the macro if you're going to take a trade. If you sweep out the pre-market low or the pre-market high at 929, 930 or 931. That was said multiple times in the Silver Bullet mentorship. So that's pretty much it for the market review. It's very simple. It's just on the AM session. The rest is in the roundtable. So thank you for watching. Hopefully you've learned something. Hopefully you're coming away with something. Goodbye.